In this video, we will cover what the world's greatest investor Warren Buffett has to say about mergers and acquisitions through his letters to shareholders. Point number 1. What is mergers and acquisitions? A merger can be understood as combination of two companies to form one, while acquisition is one company taken over by the other. According to Warren Buffett, businesses that are good candidate for acquisition should have excellent economic characteristics and a management that can be trusted and admired. In search of such businesses, companies must adopt same attitude one might find appropriate in looking for spouse. It pays to be active, interested, and open-minded, but it does not pay to be in a hurry. Try to buy good businesses at fair prices rather than fair businesses at good prices. Point number 2. Bad motives for acquisitions. Acquisition decisions must be aimed at maximizing real economic benefits, not at maximizing either managerial domain or reported numbers for accounting purposes. Where in the long run management stressing accounting appearance over economic substance usually achieve little of either. Regardless of the impact upon immediately reportable earnings, it is rather desirable to buy 10% of wonderful business at X per share than 100% at 2X per share. Most corporate managers just prefer the reverse. Point number 3. What does good acquisitions look like? Buffett acknowledged two categories of acquisitions that have been dazzling. Number 1, companies that have purchased businesses that are particularly well adapted to an inflationary environment. Such favored business must have two characteristics. A. Ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And B. An ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment of capital. 2. Second category involves the managerial superstars, men who can recognize rare prince who is disguised as a toad, and who have managerial abilities that enable them to identify such opportunities. Point number 4. Different methods of payment for acquisition. 1. Payment by cash. The form of payment generally preferred by shareholders to acquire is cash. This is usually done when stocks are selling far below intrinsic business value. Number 2. Payment by exchange of stocks. Such acquisition involves an exchange of stock based upon an identical valuation method applied to both companies. Acquirer wishes to use his own stock as currency for the purchase if the stock is selling in the market at full intrinsic value. At Berkshire Hathaway, Warren Buffett follows a simple basic rule on share issuance. We will not issue shares unless we receive as much intrinsic business value as we give. Suppose an acquirer has its stock selling at only half intrinsic value in market. Then the buyer is faced with unhappy prospect of using a substantially undervalued currency to make its purchase for full valued property. In this case, he is paying more and getting less. Under such circumstances, marvelous business purchased at a fair price becomes a terrible buy. Point number 5. Wrong rationale employed by stock issuing management. 1. The acquired company is going to be worth a lot more in the future. If the management has reasonable faith in future prospects of the company being acquired, they should pay in cash. 2. Acquire by raising capital through issuing stocks. The reality is that all existing businesses shrink when shares are issued. For example, your family owns a 120-acre farm, and you invite a neighbor with 60 acres of comparable land to merge his farm into an equal partnership with you to managing partner. Then your managerial domain will have grown to 180 acres, 120 plus 60. This will permanently lead to shrinking your family's ownership interest by 25%. That is, 180 divided by 2, which is 90. 25% lesser. Managers who want to expand their domain at the expense of owners might rather consider a career in government. Point number 6. 3 ways to avoid destruction of value for old owners when shares are issued for acquisition. 1. To have a true business value for business value merger. 2. When the acquirer's stock sell at or above its intrinsic business value. This is because out-of-pocket expense will be lower for acquirer, thus creating value for consolidated firm. 3. The third solution is for the acquirer to go ahead with the acquisition, but then subsequently repurchase a quantity of shares equal to the number issued in the merger. This takes us to our next point: to not dilute earnings. Point number 7. Value diluting stock effect. Stock dilution, also known as equity dilution, is the decrease in existing shareholders' ownership of a company as a result of the company issuing new equity. New equity increases the total shares outstanding, which has a dilutive effect on the ownership percentage of existing shareholders. What really counts is whether a merger is dilutive or anti-dilutive in terms of intrinsic business value. One of Buffett's openly claimed mistake was to issue equity to buy a shoe company whose synergies did not follow. This was an expensive mistake, claims Warren Buffett. At Berkshire, the goal is acquire either part or all of businesses that they believe they understand, with good and sustainable underlying economics, and that are run by managers whom they like, admire and trust. Point number 8. What is a leveraged buyout? Its advantages and disadvantages. A leveraged buyout, LBO, is the acquisition of another company using a significant amount of borrowed money to meet the cost of acquisition. In a leveraged buyout, LBO, there is usually a ratio of 90% debt to 10% equity. Advantage. The main advantage of a leveraged buyout to the company that is buying the business is the return on equity. Using a capital structure that has a substantial amount of debt allows them to increase returns by leveraging the seller's assets. Disadvantage. From a buyer's perspective, LBOs have some risks. The main disadvantage is that, once the deal is completed, the target business is very leveraged. This scenario allows for little margin of error. A problem with liquidity, such as the loss of a few key customers, could put the business in serious distress. Point number 9. Sound acquisition policies. In making sound acquisition policies, Berkshire always makes sure that they compare any acquisition move they contemplating with dozens of other opportunities open to them, including the purchase of small pieces of best businesses in the world via the stock market. Berkshire's key points on acquisition are as follows. 1. Large purchases. 2. Demonstrated consistent earning power. Future projections are of no interest, nor are turnaround situations. 3. Businesses earning good returns on equity while employing little or no debt. 4. Management in place, no worries to supply it. 5. Simple businesses. Lots of technology, makes it hard to understand business. 6. An offering price. We don't want to waste our time, or that of the seller, by talking about a transaction when price is unknown. Berkshire prefers to buy for cash, but will consider issuing stock when we receive as much in intrinsic business value as we give. Berkshire's preferred form of purchase is one in which the company's owner-managers wish to generate significant amounts of cash, sometimes for themselves, but often for their families or inactive shareholders. At the same time, these managers wish to remain significant owners who continue to run their companies just as they have in the past. Point number 10. Which businesses to avoid to merge or acquire? There are 2 such type. 1. An acquiring company located elsewhere, but operating in your business or somewhat akin to yours. Such buyer, no matter what promises are made, will usually have managers who feel they know how to run your business operations, and sooner or later will want to apply some hands-on help. 2. Owner operating with large amounts of borrowed money that plan to resell either to the public or to another corporation as soon as the time is favorable. Point number 11. Berkshire view on acquisition. At Berkshire, they buy businesses to keep for long term. When they buy a business, the seller runs it just as they did before the sale. Berkshire adopts to their method rather than vice versa. Berkshire encourages operating member of family to retain a 20% interest in the business and rest 80% for Berkshire. They would not want to buy a business unless they felt key members of present management would stay. Warren believes the owner would be no richer after the sale than now. The ownership of their business already makes them wealthy and soundly invested. A sale would change its form, but not the amount. Sale would have exchanged a 100% owned valuable asset for another valuable asset. That is cash. Will probably be invested in small pieces of other businesses that they understand less well. Point number 12. Who would Berkshire like to sell their business to? 1. Warren Buffett finds it meaningful when an owner cares about whom he sells to. They like to do business with someone who loves his company, not just the money that a sale will bring him. When this emotional attachment exists, it signals that important qualities will likely be found within the business. 2. Honest accounting, pride of product, respect for customer, and a loyal group of associates having strong sense of direction. Our long-vowed goal is to be the buyer of choice for businesses, particularly those built and owned by families.